Everyone, we will be starting in about 2 minutes, so go grab a quick drink of water and we'll be right back. Everybody, I am excited to be with you this morning as we go ahead and structure another position for our monthly income approach. We've had a lot of volatility, and so what you're going to see today is a skew in between the puts and the calls. There's going to be a large skew for the 90% probability on the put side of the options chain, and we'll look at that today. But before we do that, I want to take a quick look at last year. Hope you guys are doing okay. Why don't you guys let me know if you can hear me okay just in the chat box. Also, just by way of some house cleaning, make sure that you go and click on, there should be a little settings icon in the video here where you can make sure that you've got a HD view of the presentation this morning, the trade room this morning. So if you just click on that little settings icon, go up to auto, make sure it goes up to 720p HD. That way you've got a really clear view here of our screen. Let's go over here and take a look at last year. This will be our first position for January 2016, or for the year 2016, but last year we had a pretty good year. Had a couple of drawdowns here, nothing serious, but certainly had a few drawdowns, but for the most part we were able to make up those losses completely via the adjustments that we did. So what I'm in the closed positions log here in the for the monthly income strategy, and as you can see, we had a decent year. We closed up on the year 37.71%. with 85.7% of our positions going in our favor. So last year we had 14 positions that we ended up putting on, and ended up having 2 of those go against us, and we adjusted those. One of them for a profit, one of them for basically a break even, but all in all, it was a pretty good year last year. So let's go ahead and take a look here at our position. Now, remember, folks, that we structure our short call and our short put at the 90% probability area. So let's go ahead and pull up our chart here and take a look at the overall broad market. Again, we've had a nice pullback here. We are coming into some what could be support area, but it's tough to say. It's so short term. I'm just not quite sure. So let's go over here to our trade tab, and what we're going to find here is we're going to go out to the second Friday in February options. That's 32 days away. And what we're going to do is we're going to find the options with a 90% probability of expiring OTM that's out of the money, or the 10-cent delta. Either one, you'd be okay with going either one. I'm going to stick with the 90% probability options. That would put us at about the $16.95 strike price. So let's go ahead and sell. I'm going to right click on that bid column there, go down to sell. We're going to go down to Iron Condor. This is going to structure the put side of the position. We need to go and make sure that we have the correct strike price on the call side. So let's go up to the 90% probability there. We're looking at the 2045 strike. And we're going to look to sell the 2045, and we're going to look to buy that 2050. Now this is the side that I want to be cautious on, folks. I want to make sure that we don't run into any major barriers here if we do get a little bit of a pop. So let's go over here and put this, actually first and foremost, let's throw this trade over here into our Analyze tab, and we'll analyze this position. But before we do that, let's go ahead and let's put this on our chart over here. Okay, so we're gonna put, I'm just gonna have one contract in here for the analysis. And then let's go ahead and put the 2045 and the 1695 on our chart, those price areas. So we're gonna put 2045, this solid red line is going to be our short call strike price, and then the 1695 is going to be that solid green line. Hal says, what trade? I'm not quite sure what you're referencing there, Hal. If you can, let me know. Did I say something about a trade? I'm not sure. Anyways, let's go ahead and structure this position. Okay, so that solid red line, that's going to be our short call strike price. That solid green line, that's going to be our short put strike price. Let's go over here to our risk profile, actually our trade tab here. What we're going to do is we're going to figure out about when we'll need to adjust this position. So what we're going to do here is we're going to take the distance between our short call strike price, which currently has a 90% probability of expiring out of the money. We're going to take the difference between that one and the one that currently has about a 70% probability. So the one that currently has about a 70% probability is that 1975 strike price. So the distance between our 2045 and our 1975 strike is going to be 70 points. If the market were to rally 70 points here, again, the distance between our short strike price and the one that currently has a 70% probability, if we were to rally 70 points, that's about where our 2045 would have a 70% probability, which is where we would adjust our position. So if you're not familiar with that, go back to the monthly income training and watch those. Oh yes, sorry Jim. Yeah, we're in the Feb 2nd, the second Friday in February, 32 days away. Yeah, sorry about that. No, Hal, not yet. Not yet. We haven't placed it yet. We're doing that right now. Okay, so let's tack 70 points. We're going to add 70 points to where we're currently trading. We're currently trading at 1923. So let's add that. So 1993, it was a good year, right? 1993 is about where we would have a 70% probability in our short call strike price. So that's our dashed red line there. Let's go ahead and set up the alert level for the put side of things. So again, we sold the 1695 strike price, the 1695 strike price. The difference between 1695 and the option that is currently trading at a 70% probability, which is the 1840. So 1840, 1695, that's 145 points. If the market were to drop another 145 points, that's about where we would have a 70% probability in our short put. So let's go ahead and put this down 145 points from where the market is trading at. That puts it down at 1778. Certainly you can see that skew that was mentioned by Robert early on in the trade room. As you can see, we're skewed in a big way down on the put side of things as the market is pricing further downside in the market with that increase in implied volatility. Nancy, great question. The reason why we're using the second Friday in February options is because we can trade those all the way until the Friday close of the market on that second Friday of the month, whereas the regular monthly options, we'd have to get out of our position prior to the close on Thursday, on that third Thursday. Go and watch in the monthly income training. Head over here to the monthly income training course, if you will, and watch this class in week 1. Nancy, we get in depth into why we trade the second Friday of the month options. Go down here to the archives, live archives, essential archives, and watch this training. It's about an hour long, about an hour and 20 minutes long, but that's going to walk you through why we trade the second Friday of the month options instead of the regular monthly options. It's a fantastic question, Nancy, and you'll get about a 20-minute explanation in week 1 of the monthly income training. So go watch that. If you have any other questions on it, head over to the monthly income forums, just the Trader Engage forums. You can access that from any one of these panels and go ahead and post a question in the Super Trader Engage area, and we'll make sure to answer that question. So in any case, this would be our ranges here, folks. Now, this position would expire on the second Friday of February. Absolutely, Nancy, not a problem. Happy to do it. That would be the 12th of February here. So let's go ahead and make sure this thing is sitting on the 12th of February. There we go. And I'm just going to take a little snapshot of our chart here so I can provide you guys with these notes when we are done. Okay. I've got that chart in our notes now. Now let's go over here and plug those 70% probability levels into our Analyze tab, where we will analyze what our loss will look like. We want to make sure that that loss is no more than 2 times what our reward is. So again, our loss areas are going to be 1993 and 17. Was it 1779? Yeah, I believe it was. Let me just make sure. 1778, 1993 and 1778. So I'm going to plug that in to 1993 is going to go just above the middle number there, and 1778 is going to go just below the middle number there, and that's going to spit out what our losses will look like. Oh, not 1193, I meant 1993, folks. Sorry about that. Okay, and I'm going to put in our short call strike price up at the very top here. 2045 is our short call. 1695 is our short put. I'm going to put that one at the very bottom here so that you can see if you were to allow the market to go all the way to your short strike prices, the loss is just too significant here. Okay, so in this case, we are bringing in a nice premium of about 85 cents. Actually 90 cents is what it's suggesting, and that's not surprising to me because of the increase in implied volatility. If there's any way that I can raise up that 2045 strike, I'd actually like to look at doing that, folks, due to the fact that we've got just a market that has tended to form these V bottoms. V bottoms are just this pattern where it forms a V pattern. You know, you've got the big flush out and quickly rallies higher. V bottom early last year and rallies higher. V bottom here, rallies higher. V bottom, rallies higher. Is this going to be another V bottom? I don't know. The market seems really heavy right now. We keep on opening higher and we keep on getting slammed lower throughout the day. So I don't think that the lower momentum is over yet. I think that we could continue to see continued downside. So But that's what the adjustment process is for, and we will adjust accordingly if we have to. So I'm going to go for 90 cents on this one. If I let's go for 90 cents here. Let me go ahead and take a snapshot of our levels here. I'm going to highlight where those loss levels would be, what our loss would be, and it looks like it's about a 1-to-1 if we go up and hit our short call exit area, and it's far less than a 1-to-1. We're only going to be down about 20 cents, $20 per contract, which is 20 cents per contract for a 90-cent reward per contract, which is fantastic. We're going to copy this. We'll put this in our notes. Let's put that there, and we will start to fill out our little trade ticket here. Okay. How many of you were with us last month in our trade last month? Boy, that was quite a Friday afternoon, wasn't it? Oh, man. That was pretty wicked. Okay, let me take a snapshot here of our order. Yeah, I'm going to go for about 90 cents here. Sorry, folks, just getting us in these notes so we can fill out our trade ticket. Robert says way too close for him. Hal says yes, nice profit. Yeah, it was a good one. It was a good one. Jim, were you with us in last month's? That was wild. All right, let's go ahead and fill this puppy out here. So this would expire on the second Friday in February, which is the 12th of February. So we'll go ahead and put that here, the 12th of February. We're going to look to sell the 2045 call. We're going to look to buy the 2050. We're going to look to sell the 1695 put. And we're going to look to buy the 1690 for a whopping 90 cents of premium. Now, I'd be okay with 85 cents here. Our risk to reward is well within the parameters that we look for. So I'm okay with taking on a little bit less if we need to here, but I'm gonna shoot for that 90 cents here. See if we can't kick off 2016 with a boom. 90 cents divided by 410 gives me a return on my risk of 21.95% in 32 days. That's beautiful. As far as my loss management is concerned, my profit management, my position management plan has two forms of management: loss management and profit management. And as far as our profit management, we will typically allow those to expire worthless. Truthfully, there's nothing wrong with buying it back for 5-10 cents, but that does add up over the course of a year. You're giving back an entire month's worth of premium if you're doing that. So as far as our loss management is concerned, we'd look to limit our losses to no more than the maximum of the two sides here. So of these two sides, our maximum would be around $93. Divide that by 100, which equals one contract. We've got around 93 cents. So I'm going to go ahead and bump that up just a little bit here. And I'm going to say that we're going to look to limit our loss to no more than $1, about 10 cents more than what our premium is. Truthfully, what we want to have, we don't want that loss to be more than 2 times our reward. So we wouldn't want to take a $1.80 loss here. Is really the maximum loss that we'd want to see taken. So again, there's a lot of room for this market to move around, and a lot of room for the loss that we can take. So we're going to look to limit our loss to $1. We observed through the risk profile on the Thinkorswim platform, TOS, that we would have around a 93-cent loss. We'll go ahead and bump that up, 94-cent loss if the short call strike went to a 70% probability of expiring out of the money, which would be around that 1993 price level. So 1993 is about where that would occur. Also, we would have around looks like a 20-cent loss if the short put strike went to a 70% probability of expiring out of the money, which would be around that 1778 price level. So as you can see, the effect on this position to the downside is a lot more minimal than the market rallying here, but both of these losses are well within the parameters that we like to see. Again, we go through all of those risk parameters in the monthly income training, so make sure that you go back and watch that if you have not. That will be really important for you to do. As far as Jim says, he says the 1695 put is at a, let's see here, the 1695 put that we're looking at has a, let's see, 1695 put has a 0.09 delta, and right here, where is that at? Right here. Well, I don't have them split up, but yeah, so we've got a 0.09 cent delta, and he says, why is it significantly lower than the 10 delta you would normally expect? The 10 delta strike is 1710 strike currently. So, really, right now, the 90, so what he's talking about is the 90% probability typically has around a 10 cent delta. And the reason why the 90% probability right now does not have a 10 cent delta is due to the increase in implied volatility that we've just had, Jim. That's why we're pricing options further out with a 90% probability. But frankly, I think you'd be just fine going with that 1710 or that 10 cent delta. If you just have delta on your platform, you don't have this probability of expiring out of the money. The probability formula that they use at Thinkorswim is a combination of standard deviations, average true range for the past 32 days, and implied volatility. So it's a combination of all those factors. We talk about that in that statistical probability class in the monthly income training. So if you go to, I believe it's week 2 of the monthly income training course, Jim, week 2 statistics and probabilities, we do discuss that just a bit. And then the increase in implied volatility, Carol, that is seen, you can come over here and tack that on by going to studies and finding implied volatility, and that can be tacked on there to your chart. And as you can see, we've had an increase in implied volatility there due to the retracement of the market. So that's where you can see that, Carol. Good question. So folks, I'm okay with this position. I think that we may end up needing to adjust it possibly, unless this market continues to fall down, which I actually don't think is beyond the scope of what will probably happen here. Yeah, Robert, I don't know that it will fill at about 90 cents. I think 85 cents is probably more fair value for this particular strike price, or for this particular set of options here. So that doesn't surprise me that we're not seeing a fill here yet on this position for 90 cents. It's looking like fair value is trading closer to about 85 cents. So that's probably, more accurate. And again, that's well within our parameters here. 85 cents is definitely above what the minimums we look to bring on. We look to bring on a minimum of 65 cents. Again, folks, go back to the monthly income training courses if you haven't watched those, and that will get into all of these bare minimums that we look to bring in here. So I don't think this will change a lot of what we're doing here, but yeah, we'll put this at 85 cents and see if we can't get that. Okay. Any questions, folks, on anything that we've done here today? Any questions? I'll go ahead and I'll get these notes. Actually, you know what? You can find these notes and you'll be able to watch the recording of this in the open positions area once our position gets filled. Oh, Carol says she lost sound. Is everybody else hearing me okay? Sound okay? Am I coming in all right, guys? Jim says it's okay. Let's go ahead and do this then, folks. Let me take a snapshot here of this note, and I'm going to stick this in the chat area so that you guys can have this until I get the open positions log updated for the monthly income stuff. So let's go over here and get this posted up for you guys. Okay, so it sounds like you guys are all getting sound here. Carol, not quite sure what's going on there. Is there any chance that you may have muted yourself there? Any chance you may have done that? Probably not, but worth a look. I know I've done crazier things. So I'm gonna post this note in the chat log here, so you guys should see that popping up, and you can click on that note and it will be enlarged. So go ahead and do that. And again, as far as position sizing, folks, again, we're starting a new year here, so just following the rules for this trading system, we're going to start with $100,000. Again, we start with $100,000 at the very beginning of the year, and we use only 20% of that portfolio for this position. We leave 80% in cash for adjustments, etc. So if I'm starting with $100,000, 20% of that is 20 grand. Pretty easy math. So if I've got 20 grand of risk capital, I'm going to take 20,000, divide that by $4.10 of risk per contract, and I'll divide that number by 100. That means I can take on 48.78 contracts here. Actually, you know what? One thing I failed to change here was we're going to do this at 85 cents. I don't think that it will change the number of contracts we've got here by very much. Maybe one or two, but I do want to make sure that we get that change in here. So that's a 20.48% return on risk in 32 days instead of the 21. So if I've got 20 grand of risk capital divided by $4.15 of risk per contract, yep, same thing, 48 contracts. I can take on 48 contracts here for that particular position. And has anybody gotten a fill yet on that one? Anybody gotten a fill yet? Awesome. Okay, so yeah, it looks like we're lobbying here, but not quite getting a fill. I'm going to keep mine at 85 cents there, folks, and go for that with the heightened volatility. I do want to try and get my my premium here just a little bit higher than normal. Last year we had anywhere between 75 and 70 cents in premium on average for our positions. So with the increase in implied volatility here, I do want to see if I can't bring on a little bit more in premium. So I'm going to stick with 85 cents. Frankly, 80 cents is not anything to be ashamed about either, and well within our risk parameters as well. So I'm okay with that if we had to go down to 80 cents as well. But I'm going to keep mine here at 85 cents for just a little bit. And if it didn't get a fill here within, say about the next 30 minutes or so, I'll probably take that down to 80 cents. The minimum that I'm going to look to bring in here is 75 cents. That's the bare minimum I'm going to look to bring in here. So yeah, it looks like the mid price right now is trading at about 80 cents. So yeah, not filling right now. But again, I'm going to give that about another 30 minutes here frankly, if you just wanted to be one and done with it, throw it up there at about 80 cents and you should get a nice quick fill on that. Right now, they are, looks like they are trading them at about 80 cents. So you could probably get a pretty quick fill there at 80 cents, which is great premium for this position. Our average over the past 8 years has been 65 cents. That's our average monthly premium. So we're certainly, bringing anything above 65 cents is above average, which I would expect above average premium for this month with the increase in implied volatility. Okay. Any questions, you guys, on any of this stuff? Sorry, Carol, about your sound. All right, folks. Well, I'm going to wrap it up here. We will be doing, I'll be sending out a schedule here. We're going to be doing live trade rooms pretty much every single day of the week. On Mondays, we're going to be doing basically a planning session. We're going to be looking at all the stocks we're going to be looking at for the week, so everybody's on the same page. I'll be sending that out here later on this afternoon, and you guys should have that schedule. So look forward to heading over. If you guys want to watch this again, you can head over to the open positions log. I will post everything there in addition to these notes. If you would like to click on and see the note for this current position, I will post that again here in the chat area. I'm doing that right now. So if you would like to take a look at this notes log for this particular trade, just go ahead and click on that image that is uploading right now before your eyes. It should have uploaded just now. Just go ahead and click on that. That should open up the notes for this current position there. Oh, you know what? I'm sorry. That was the wrong one, folks. That was the wrong one. Either way, I will get it posted up here right away, and you guys should be able to see that in the open positions log here for... that's weird, not seeing it. So either way, I will get it up in the open positions log. Give me about 5-10 minutes at the open positions log, and it looks like they're filling them right at 80 cents, folks. So if you want a quicker fill, looks like they're filling them at 80 cents, which is nothing terrible. That's fantastic, and certainly something to write home about. That's a really good fill price there. Congrats, Hal, Robert. And make sure, folks, to set alerts here to be notified if it hits 1993 or 1778. Simply right-click on the line, create alert withdrawing, and we're going to say, let us know if it crosses above that level. We'll create that alert. We're going to create an alert down here on that dash green line. That is where we will look to adjust. If this is new to you, go through the monthly income training course. Go through that. 1993 HAL is our alert level for the call side of our position, and 1778 is the alert level for our put side. Okay. All right, folks. Look forward to a great month and a great year here with you. And I will be sending out a schedule for all our new trade rooms that we're going to be doing for the different trading systems that we've developed here. In addition to the one that we're doing right now, the monthly income, we've got 2 other ones, the capital growth and the explosive profits. I'll be sending that out. Look for that in your inboxes. If you have any questions, don't hesitate to get a hold of me. Either send me an email or head over to the Trader Engage forum, post a question, and I will get that sent off to you. So everybody have a great rest of the day. Hope you have a fantastic month and year with us. And it's just a pleasure serving you all, and look forward to serving you throughout 2016 and beyond. As always, until next time, trade super.